Welcome to The Explainer. Look, today we are diving straight into a total masterclass on honest finance. We're skipping all that generic advice you hear a million times and getting right into the actual insider strategies the top 1% use. You know, the real playbook for escaping the rat race and securing true, lasting wealth. Let's get right into it.
We've got a seriously packed roadmap today. We're covering everything from the hidden forces secretly destroying your money, the real math of compounding, the actual playbook for earning and spending, avoiding the debt trap, and finally, winning the equity game.
All right, Section 1, the real wealth killer. We're going to expose the invisible enemy of your wealth. And trust me on this, it's totally different from what the mainstream news tells you.
So, you've probably asked yourself at some point, right? Is my hard-earned money actually growing when it's just sitting safely in a bank account? I mean, you work hard, you squirrel your savings away, and you feel totally secure. But there's a silent drain on that account, and it is operating 24/7, eating away at your cash.
Okay, here is the harsh reality. The real inflation eating your money, it's actually 8 to 10%. Yeah, not that standard 4 to 6% they talk about on the evening news. Why such a massive difference? Well, the government tracks the Consumer Price Index, right? But that averages out everything across the whole country, including all those heavily subsidized basic goods. But your actual expenses, the ones that define your lifestyle and your future goals, those are skyrocketing way past that blended official number.
I mean, major life expenses are just rising so much faster than the official CPI. The real data is kind of scary. Education costs are growing at over 10%, and healthcare, that's shooting past 13%. It's literally turning your childhood 5-rupee samosa into a 20-rupee luxury item. So when inflation is running this hot, your money is actively losing its purchasing power every single day, no matter how safe you think it is in the vault.
And to make matters even more complicated for anyone trying to build wealth, let's look at the tax base. Out of India's massive population of roughly 1.5 billion people, only a tiny sliver actually pays direct income taxes. We're talking only about 7 crore people who even file, and of those, just 2 crore pay actual direct end taxes. So this incredibly small group is heavily carrying the financial weight of the whole system, all while battling that 10% real inflation we just talked about.
So what does this all mean for you? The absolutely crucial point here is that after you factor in a 30% tax bracket and that 8% real inflation, both savings accounts and fixed deposits actually yield negative real returns. Seriously, if you put 1 crore in a savings account at 3.5%, after taxes and real inflation, your money is effectively shrinking by 5.55% a year, every single year. Even in what looks like a super safe 7.4% fixed deposit, you're still losing 3% of your purchasing power annually. The number in your account might look bigger, sure, but what you can actually buy with it is shrinking. The bank is literally, albeit slowly, making you poorer.
Okay, moving on to Section 2, the math of compounding. Now that we know the bank is slowly draining our wealth, let's look at the absolute best antidote. Compounding is often called the 8th wonder of the world for a reason, and we need to know exactly how to make it work for us.
Have you ever heard of the rule of 72? It's a neat little trick to easily calculate how long it takes to double your money. You just divide 72 by your interest rate. At a standard 7%, it takes over 10 years to double. But watch what happens when you start optimizing. If you hit a 10% return, you double in just 7.2 years. And if you manage to bump those returns up to 15%, you're doubling your money in under 5 years. This simple math, compressing the time it takes to literally duplicate your capital, is the absolute baseline for everything the wealthy do.
That brings us to Section 3, the playbook. With the math clear, let's jump right into the core rules of the game. Earning more and spending less. I know, it sounds incredibly simple, almost too simple, right? But the execution is exactly where 99% of people fail.
So to earn more, you've got to focus on increasing the scale of your capital. Think about it. A brilliant trading strategy on 8,000 rupees yields absolute pennies, but that exact same strategy on 8 crores, that yields millions. Next step, move your job address to where the money flows. This is geographic arbitrage. Richer nations or Tier 1 cities simply pay dramatically more for the exact same work. And step 3, become an irreplaceable A player in a specific niche. Once you have a highly specialized, in-demand skill, you completely stop being a replaceable commodity, and you become a premium asset.
Now on the flip side, to spend less, you have got to avoid the FOMO trap. You know exactly what I'm talking about, trying to keep up with old friends who are out there buying flashy cars on EMIs.
The source material strongly advises completely distancing yourself from circles that trigger insecurity and unnecessary spending. It's also super important to make sure you marry a partner who shares a strict growth mindset. Oh, and for sure, stop trying to compete with ultra-high net worth individuals. Remember, those people are funding their luxury lifestyles entirely from the interest generated by their massive capital reserves, not their monthly paychecks.
All right, Section 4, Avoiding the Debt Trap. This is arguably the biggest roadblock for the middle class. The debt trap is literally the exact opposite of compounding wealth. It is compounding your poverty.
Listen, if you genuinely want to reach the top 1%, you absolutely must steer clear of personal loans and credit cards. They are heavily, and I mean heavily, marketed to feed on your desire for instant status. The system thrives on making you feel isolated and insecure. It constantly pushes you to buy things you absolutely don't need with money you don't even have just to impress people you probably don't even like.
The harsh truth here? Debt should really only be used as a calculated business tool by folks who could repay it 5 times over in a worst-case scenario. It should never, ever be used to fund a depreciating lifestyle. We're talking things like throwing a massively lavish wedding or buying a brand new car just to show off to the neighbors. It's just not worth it.
And finally, Section 5, Winning the Equity Game. Let's dive into how to invest wisely for the long haul. Look, I know stock markets can feel incredibly intimidating, but the 1% playbook actually simplifies the whole shebang drastically. Let's break it down. For most of us busy professionals who simply don't have hours every single day to stare at charts and study the market, placing your money in a low-cost, less volatile index fund like the Nifty 50 is absolutely the smartest play. You are basically betting on the top 50 companies that drive the entire economy, which naturally spreads your risk. And honestly, more importantly, it saves you time. You don't have to read dense balance sheets or obsess over daily news because the index just automatically does all that filtering for you. Now, this comparison is going to shock you. The hidden expense ratios on an active fund can literally cost you over 5 lakhs in fees on a 1 crore investment over a decade. Compare that to just 1.5 lakhs for a passive index fund. These seemingly tiny fractional percentages, they're quietly being deducted from your account every single day, completely irregardless of whether the fund is making money or losing money for you. This right here is exactly how brokers get rich off of your capital.
So, what's the real secret to equity? It's not about chasing prices, it's about understanding value, margin. Think of it like buying that metaphorical samosa we talked about earlier, but only when the market temporarily prices it lower than its actual intrinsic value. If a samosa's fundamental value is 20 rupees and the market crashes in a panic and prices it at 15 rupees, boom, you buy. But if it drops from 35 to 30, it's still way overpriced, so you hold back. It's always about value over price.
Take a look at the historical timeline of the Indian market. We see these massive booms followed by utterly dead decades, which just proves that absolutely nobody can consistently time the market. I mean, between 1979 and 1992, the market boomed at an incredible 30%. But then, from 1992 to 2000, returns were basically zero, nothing. And other global markets like Japan and China have seen their stock markets stay flat or even go negative for decades at a time. This really highlights the absolute danger of short-term thinking.
And because you can't time the market, your ultimate strategy has to be consistent investing. Just remember Warren Buffett's golden rule. Be cautious when everyone else is blindly chasing the hype. When your neighbor is bragging about massive quick returns, that's exactly the time to step back. But when the market panics and prices drop well below their intrinsic value, well, that is exactly when the top 1% quietly step in and buy more.
So, racking this up, the ultimate question you have to ask yourself right now is this. Will you stay trapped, endlessly working for your money, or will you use this playbook to actually make your money work for you? You've got the math, you know exactly where the traps are, and you understand the power of index funds. The next move is entirely yours. Thanks so much for tuning into this explainer, and keep learning.